This week on the Wealthy Pilots podcast, investing. It's one of those components we got to deal with when putting together a good strategy. So let's get into it with the Pilot's Planner, Scott Osborn.
We've got some turbulence up ahead. Reach out to the Pilot's Planner.
Hey everybody, welcome into the Wealthy Pilots podcast with Scott Osborn and myself. And this week on the show, we're going to talk about investment ideas, investment plans, strategy, conversation pieces with Scott, just to kind of think about this from that piloting perspective as well. So let's get Scott in here and get talking about it. What's going on, my friend? How are you?
Hey, Mark. Doing great. How about you?
Doing fantastic. Good to be back with you, having this conversation today. And I want to dive in and just get rocking on this, Scott. Let's kick into just that whole DIY movement versus working with an advisor. I want to start there because the last couple of, the last number of years, right? Really, it's been fairly easy to kind of DIY it. Yeah, since 2022, it's been a little shakier, right? But, the 8, 9, 10 years prior to that, market was pretty much on a tear. So it makes it a little easier when you can throw a dart at the dartboard and kind of do all right? But now that things have gotten a little shakier and we've had these inflation rate changes, and now we've got this crazy election year that we're in with the time we're taping this, it starts to kind of change things a little bit. And what you don't know could come back to bite you. So talk to me about the difference between being a DIYer and working with a qualified pro.
Yeah, I think, there's nothing wrong with doing it yourself if you have, I would say, like the passion for it and the time for it. And like the time is probably the biggest one. I'll almost say like the intuitive prioritization for it. We all have 24 hours in a day, and it's not like this takes 30 hours a week to manage your investments. If you're spending that much time on it, you're probably doing something wrong and getting worse results than you should be getting. But even just taking, an hour a month to do some rebalancing or to do some journaling from one account type to another. It's just, if it's not in your standard routines and it's not in your annual or monthly or quarterly cadences of what you're doing in your household, with the same discipline that you're paying the mortgage, then you're probably leaving some returns on the table typically. And so again, there's nothing wrong with DIY, but the data would suggest that the DIY investor significantly underperforms not only the market, but they underperform managed accounts. And so this is where a lot of times when we're talking with clients, like, hey, we're not necessarily trying to beat a market. We're trying to beat what you would do on your own. And
well, let me expand on that. Let me ask you about that. So Vanguard, right, is one of the cheapest options out there. A lot of people doing DIY investing. You can go to Vanguard. They actually, every couple of years or so, they put out their report talking about, the value that advisors bring. And even they, who are the cheapest option for DIYers, again, say advisors bring on average, around 3%. Possibly up to 3%, improvement in your portfolio. And a lot of it's around behavioral management, right? Because we're typically our own worst enemy.
Yeah. So you have a situation where most people, when they're like hardcore DIY till they die, they're either making bad decisions or they're backing themselves in a corner and they're making no decisions. And the no decision could be from being too busy, not caring about it enough, or from like decision fatigue. Like, I'm not sure which option to pick, so I pick no option. And so, that kind of lack of system around their decision-making causes them to make more knee-jerk reactions or no reactions, which is neither one of those is ideal in terms of when we're trying to get, good long-term returns. So, I think that same study, they basically determined over a person's working career with those returns working in their favor, again, net of fees and expenses, they would retire with, over 70% more money, which is a significant number.
That's a big number.
Yeah. So
nothing to sneeze at, that's for sure, right?
Absolutely.
Yeah. Okay. So again, there's nothing wrong with DIY in it, but I think, ultimately at the end of the day, everybody's heard these kind of analogies, getting up the mountain is a hell of a lot easier than getting back down it, right? More people die coming down Everest than they do going up it, right?
Right.
So, and you're thinking about, the journey into wealth, building it, it's not nearly as hard as keeping it and then distributing it as you're aging, right? So that's really kind of that core piece I wanted to talk about, that DIY versus the advisor.
Well, and it's interesting too, right? When you think like especially in this pilot community, let's say you're a new pilot and you're coming in with no assets, but you're getting a good income. You're going to start maxing your 401k. Man, it's not going to take long between your 401k and the match and profit sharing before you start to get a pretty good nest egg built up. And so the earlier you can get on that getting that 3% net returns on average, so to speak, the more wealth you're going to be able to build. But that doesn't mean this late stage pilot is like out of the game. I mean, they've probably still done pretty well for themselves. And then it still comes down to like, hey, how do we make the best decisions with the income we have and the assets we have? And so at the end of the day, those two things are always, in play, that we want to do the best we can with, no matter where you're at in your career, until eventually you retire and that income turns off. And we got to get income and asset management all out of the assets. So, there's a lot of complexity that comes more into that retirement side, but yeah, especially for these young and mid-career pilots as well. It's like the income and asset growing is potentially high enough that it can make a ton of sense to try to get in there and, get it to full, like our program, the full thrust 401k, like, hey, implement a lot of these strategies and start to try to get that thing growing as quick as we can. It makes a big difference over time.
Got to get some lift, right?
That's right.
All right. So let's talk about our next piece here, which is self-directed brokerage accounts in the airline world. That's a tongue twister.
Yeah, dude, this is one of the best things offered to not just the pilots, but also all the employees of these airlines. And first of all, it's not to be taken for granted because not every company offers these. Second of all, they are many times not known to be an available resource for the pilots and these employees. And so basically at the end of the day, you have like your Fidelity 401k account. And in that account, there's a handful of options for you to pick. Most people will just do like some sort of target date fund, which we very rarely recommend that being in somebody's best interest. It's better than having it all sit in cash, don't get me wrong. But yeah, again, typically not the best route to go. And in that Fidelity 401k plan, there's basically an option where you can open a self-directed account. And instead of just having, your 10 funds in there or whatever the case is and being stuck with whatever those funds are and whatever the investment style is and the fee structure is, you can open the self-directed account. And then it's like you're truly in control of that money. And you can work with different managers with different investment styles and really build a custom portfolio that's more aligned to your risk profile, more aligned to how aggressive you're willing to be. A lot of the pilots we work with are willing to be more aggressive with their money, and it can definitely pay off. But those real aggressive options are not offered in a traditional 401k plan. You got to get into that self-directed space. And so there's a little bit of diligence to do there, but it can be a great way for a pilot to more aggressively grow their money if they're comfortable with the risk levels. But again, you're not going to get in that base account. It's there. It's a couple clicks to get there, but this comes back to that DIY approach. I mean, once in my head, I kind of say, well, my 401k is taken care of. Most guys are not going to come back and think about that for a long time. Whereas if we can spend a little time up front to build a good plan and get you enrolled in this self-directed brokerage account, I mean, man, you can get that thing to take off.
Okay, good. I mean, that makes sense. And I would imagine for pilots, clearly control is something they feel more comfortable with, right? So having more control in those self-directed brokerage accounts is got to be kind of something they can kind of relate to as well, right? Because it's just kind of natural for the same position that you have in your job. It's all about control.
Yeah, absolutely. I mean, and I think the other part that's great with those two is you can bring in certain managers to manage the money for you. And like even if you look at the investment options in that account, I mean, it's incredible the different access you get to different managers that, again, you just can't get in the base 401k. And so many other people in many other Fortune 500 companies don't have this option. So it's a really, really good option. Way more access that these guys and girls have access to. They're just not taking advantage of it. So again, that's part of the reason we're doing the podcast, try to educate some people on some things. And we'll do an episode where we dive more into just that. But I mean, I like to talk about that anytime I'm talking about investments, because the 401k is most likely their largest wealth building asset. And they're just leaving returns on the table, and they're not landing in retirement with as much as they should there.
Okay. Well, again, guys, if you need some help, reach out to Scott. Find him at thepilotsplanner.com. That's thepilotsplanner.com. And we'll have the links in the show notes and everything here at the end of the show. Check the description for all that stuff. But let me ask you one final question, Scott, and we'll wrap it up. Just some main tenets of good investment planning or a good investment plan. What's some things to think about?
I mean, I think the first one is definitely what we would call like asset allocation, right? So how much stock do we want to own? How many bonds do we want to own? And then inside of that asset allocation, we have what we would call like style. And so we have some value investments, which might be like, hey, buying a stock that's beat up and at a low price that we have confidence is going to come back, and still owning some growth assets like your Teslas or your Nvidias or your Netflix back in the day or whatever the case is. And just getting that real good diversification from a style perspective. And then again, from an additional diversification standpoint, you can sprinkle in that self-directed account. We can get access to certain managers who specialize in tactical money management. So tactical money management might be like at the, end of 2021, after 2 years where the market goes up 25% up, 25%, that might be a good time where we have a manager who takes a little bit of that growth and pulls it back, sensing that there might be some sort of downturn, right? Which we did see in 2022. So there's access to different styles in there too. And I think diversifying your styles gives you a little bit more flexibility in developing your investment plan, but it also can get you better results because you're not all sold in on just tracking, one specific index. And, when that index is down 55%, you're down 55%. So being diversified in what you own, but then also being diversified in the investment style, can really drive some good results for people. And I would say the last part of that, Mark, is the asset location. So are we saving in a taxable brokerage account? Are we saving in a 401k? Are we saving over in a Roth? Like, where are the assets located at from a tax standpoint, and what are those implications? Because it matters from a total return and investment standpoint. It's not just how much is that index performing or that investment performing, but how much of that are you going to keep at the end of the day? I mean, we're trying to get our pilots to keep as much money for their family as possible.
Absolutely. So, all right. So I hope you guys enjoyed the podcast. Some good things to think about there from the Pilot's Planner, Scott Osborn. If you need some help, reach out to him online at thepilotsplanner.com. That's thepilotsplanner.com. And don't forget to subscribe to us on Apple and Spotify and YouTube. Of course, we're doing the YouTube version now. So hopefully you're checking that out. Hit the little thumbs up and the little subscribe button to get the new notifications when new ones drop and all that good jazz. And you can check the show note details for everything. We will have all the links in there for you guys to check out as well. Thank you so much for hanging out, Scott. I always appreciate your time. And we'll see you next time here on the Wealthy Pilots Podcast.
We'll see you out there.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.